What's good? It's your boy Dom. I'm back with another valuable video. And in today's video, I'm going to share with you the big banks' secrets to engineering liquidity in the Forex markets and how you, as a trader, can come in and follow their footsteps or their footprints and be profitable by doing so. All right, so let's just jump straight into it. The big banks are engineering liquidity. What you're really thinking of is how are they going to manipulate pricing or repricing, for that matter, to get people to go in on the opposite direction, right? And so your stop loss, your buy stops, your sell stops is a form of liquidity, or them creating liquidity in the marketplace. All right. And so when I'm looking at this, I'm seeing, we're seeing a bull run go up, right? The markets are built off of fear and greed, right? And so one of the first things I've always asked myself when I come to the charts, who are they trying to entice, right? And what are they trying to entice most traders to do? And if I'm looking at this chart, right, I'm looking, it's going up. Man, as a retail trader, I'm enticed to continue to go long. It's, the trend is your friend. The problem is it's not the fact that you're wrong in terms of going long. It's all about timing. Like, the timing to get in on this trade was around this area, at the low, right? Like right here, when you come in and you're seeing this trade, you're a little bit too late. So what happens, they know this. They know that people are going to trace. They know that people are going to chase trades, okay? And so this is a good example of them engineering liquidity. So let's just put some lipstick on the chart. All right. And so what I can see here is that price made a retracement, came up, price kind of stalled here. And what has been created? These equal highs. All right. These equal highs. And to the big banks, what that looks like is money. Right? That is money to them. And I'm explaining to you why. So when you have all of that and price is rejecting this area, right? Price continues to go down, right? You get into this Asian range or whatnot. So when the algorithm, or the bank's algorithm, resets at midnight every day, what happens is they're going to go seek the next draw on liquidity first, right? And they're going to look at where there are pending orders. In this instance, the pending orders would be what? Buy stops resting above this particular area, okay? And so you have buy stops resting above here because what is retail logic? Oh man, we're on a bull run, because most people don't do top-down analysis. They look at the 15-minute, 5-minute, 1 minute. They most likely look at the hour or whatever. But that's just a small fraction or a small view of things. So them knowing this, right? So you get this pullback, right, during the Asian session. All right, and so people who've seen this move happen, right? They have pending orders resting here. So they set their pending orders. They go to sleep, whatever. London happens, depending on where you are in the world. But your buy stops get activated during the London session, right? So price opens up. So price opens here, right? And so price opens up right outside of London. What happens? Goes up, activates those buy stops, those pending orders, okay? comes down again. So what happens here is that those who get activated, they're excited. They're like, shit, we're golden. Okay. Now, look what happens here. Where would most people who put pending buy stops, they're in profit, where would they typically put their stop losses? They'll probably put their stop losses. And to clarify, the big banks don't have the I want to say the actual like program to show them exactly what everybody's like, pending orders or even stop losses are, for that matter. They just know retail logic, and they use that retail logic to their advantage, right? And so most people's stop losses are going to be resting here. Most people's stop loss is going to be resting here. You may have some right here, because they may say, oh, if it breaks, if it breaks this swing low, then I'm wrong, and I can be kind of on the wrong side of the market. So this is where they will put their stop losses. They'll put their stop losses typically here, right? Because they got activated. They probably put their stop loss around here. And so what happens? So they get them activated, right? They're excited. What happens? So now liquidity has been engineered on both sides of the market. What do the big banks do? They want to clear the deck, right? So then they come back, right? They take out your stop losses. So that's liquidity engineered. That's how they create liquidity right there. Stop losses and pending orders. So they activate you, they stop you out, right? Not only that, besides these stop losses, you have individuals who also have people who are going to have pending orders for going short. So you have short stops here as well. So not only did these people who get activated, who set their pending orders before they went to sleep or before London, right? They get activated, they get stopped out, they're sad. Who gets excited? The people who said, you know what, I'm going to buy on the breakout of this low, right? They missed it during Asian, but they know, or even if they did catch it through Asian, they have short positions already being held here, right? So those in the Asian session, they probably had stop losses above the Asian high. They got stopped out. So you see how this is happening, right? And so now these short stops get activated. Those who had buy stops, they get taken out. These short stops are activated. They're excited. What happens? Their stop losses are probably above the Asian high or above these resting equal highs, right? So now they get stopped out, right? They get stopped out. They're scared. They're closing out of their positions because they're like, oh, holy shit, they actually wanted to go up. So this delayed protraction here is just like a delayed Judas swing that you can learn from ICT. But so price opens, runs higher, activates buy stops, takes them out, activates short stops, right, on both sides of the market. And then they come up, take out the people who were short here, right? Take out the people who short here, and people who were late to the party, who may have woken up like late during London, said, "Oh man, I'm gonna set some more pending orders." So now you got new active pending orders on buy stops here. They get activated. You see how this is just happening? Just liquidity just being engineered just based off of that. And so now, once they take it up, and typically, they take price up. Now they take price exactly where they wanted to take it, right? Which was down. So now nobody's left nobody's riding their coattails. But the smart money traders are the ones who understands how this liquidity is engineered and manipulated in the marketplace. I am thinking okay, I'm watching all of this and I see this happening. I'm looking at this in terms of, oh wow, this price has just, we repriced all the way to a premium, right? And I'm looking at it just how the banks are looking at it. I want to ride their coattails. I want to follow their footprints. I don't want to follow the footprints of retail logic. So I'm thinking, as price is repricing up, I am getting excited to take short positions, right? And so you ride that down, and my eyes immediately, as price is rising up, my eyes immediately go here, right? Because I see this is the next draw on liquidity, right? And so that's how you pretty much see how the big banks really just engineer liquidity and manipulate the markets to their favor. If you are on the right side of the market, if you can follow their footprints, more times than not, you will be much more profitable in the long term. Okay, now this takes a ton of finesse to get used to, but once you get used to it, you'll be in a good position. So talk to you guys soon. Hope this was a good video and informative for you.